Welcome to the Deep Dive. Today we're taking a really granular look at Sai Life Sciences, or SLS. This deep dive is for you, the investor who needs to get past the headlines and really get into the fundamentals. We're going to be synthesizing the latest Q1 and Q2 FY26 results, management guidance, and all the key ratios to give you a clear, evidence-based picture.
Exactly. And the story here is one of, well, rapid transformation. But transformation always has trade-offs, doesn't it? Our focus has to be on those inflection points, where the big investments are finally paying off, but also shining a light on the risks, things like working capital and capacity, which often get missed in the big optimistic reports.
Okay, let's start right there with the foundation. What does Sai Life Sciences actually do? The label is CRDMO. What does that mean for the business, and how does it build a moat?
Right, so CRDMO stands for Contract Research, Development, and Manufacturing Organization. In simple terms, they offer a complete end-to-end service for the big global pharma and biotech companies. They can take a potential new drug, a new chemical entity, right from the earliest discovery phase through development and all the way to commercial manufacturing.
So they're not just a simple supplier, they're more like a long-term scientific partner, embedded deep inside the client's own R&D pipeline.
That's the crucial advantage. This integrated model is a huge de-risking factor for their clients. I mean, the big pharma companies want to consolidate this complex work with partners they trust. And their value, as management often points out, isn't really tied to whether a drug gets approved or not. That's a binary outcome. They generate consistent value by just executing the science reliably. They get paid for their expertise.
And that reliability creates stickiness, which is what a moat is all about. What do we know about the quality of their client relationships?
Oh, the client base is absolutely top tier. SLS serves 18 of the top 25 largest pharmaceutical companies in the world.
Wow, so we're talking about the biggest players.
The biggest. And critically, the average relationship with these clients is over 10 years long. That kind of partnership model gives them a huge buffer against the sort of volatility you see in the biotech space, where funding can just disappear overnight.
That's a fair point, but doesn't relying on those huge global players also create a concentration risk? I mean, what if one of those 18 giants decides to bring its manufacturing back in-house?
That is a very important question, and it's something a sophisticated investor should always consider. The risk is there, but it's mitigated by how specialized their services are becoming, especially in these new modalities we'll touch on later. Look, moving the manufacturing for a complex new drug is incredibly expensive and technically very risky. The 10-year average relationship tells you that the trust and complexity involved create a really high barrier to switching. And the revenue mix seems balanced. For the first half of FY26, CDMO was 64% and CRO was 36%, which is right in line with management's target of a two-thirds, one-third split.
Okay, let's pivot to the income statement then. This is where the story goes from structural strength to actual performance. Revenue growth looks good, but the margin expansion story is really something else.
It's a phenomenal turnaround, really. Total revenue for the first half of FY26 was 1,034 crore, which is a 53% jump year over year. Q2 alone was up 36%. And if you break it down, the CDMO side was the real engine, with revenue growing 72% in H1. CRO grew at a healthy 28%.
A 72% jump on the manufacturing and development side. That is massive. So how much of that is actually converting into core profit? Let's talk EBITDA.
Right, so EBITDA, that's earnings before interest, tax, depreciation, and amortization, is basically your true measure of operational profit. For H1 FY26, EBITDA came in at 281 crore. That's a 101% increase year over year.
Doubling operational profit in a year, that's not just good performance, that signals a huge strategic shift is paying off. What's driving that kind of increase?
It's the operational leverage kicking in. This is the payoff from all that capital they poured into new plants and labs between FY22 and FY25. They were building out their fixed asset base. Now, with higher revenues, those fixed costs are covered, and more of each sale drops to the bottom line. Just look at the margin trend. EBIT margin went from about 15% in FY22 to 25% in FY25 and just hit 29% in this last quarter, Q2.
So they're already at the top end of their own aspirational guidance of 28 to 30%.
They are, which suggests the scale efficiencies are coming through even faster than they planned.
Okay, that's the operational profit. What about the final number that shareholders see, the profit after tax, or PATRI?
The PATRI figures really show the scale of the financial turnaround. For H1 FY26, PATRI was a 144 crore. That is a staggering 415% increase from the previous year. I mean, just think about this. In Q1 of FY25, they had a loss of 13 crore. A year later, in Q1 of FY26, that swung to a profit of 60 crore. The Q2 PET margin expanded to 15.6%. It shows that the operational strength is flowing all the way down.
The P&L is undeniably strong. But as we both know, profit on paper isn't always cash in the bank. The real test is in the balance sheet and cash flow. So let's go there. How have they managed their debt during this growth phase?
The balance sheet looks pretty solid. The company has actively reduced debt, and they're sitting on healthy reserves of around 2,249 crore as of September. You can even see the benefit of this in the P&L. Their interest cost dropped from 21 crore in Q2 of last year to just 9 crore this year. They're clearly optimizing their capital structure.
That's good to see. But let's get to the real test of quality cash flow. Is all this profit actually turning into cash, or is it getting stuck somewhere in the operations?
And this is where we have to raise a pretty significant red flag. It's something you really need to scrutinize. While the profitability is booming, the operating cash cycle is under a lot of strain. The data shows a really concerning trend in working capital days. This metric, the time it takes to turn cash back into cash, has ballooned from around 38 days to over 66 days in the last 3 years, and inventory days are also way up.
Wait, working capital days nearly doubled. That means a lot more cash is getting tied up in inventory and receivables just to support this growth. Is that poor management, or is it just the unavoidable cost of scaling this kind of business so fast?
It's likely a bit of both, but probably more the latter. It's the consequence of explosive growth. When you scale complex manufacturing that quickly, you have to stock more raw materials, and your receivables naturally stretch out. But the cash impact is real. In FY25, their operating cash flow, the actual cash from operations, was only 314 crore, but their capital expenditure, their CapEx, was way higher at 536 crore.
So they're burning through more cash on new investments than they're generating from the business itself, and that's continuing, right? The plan is for 700 crore in CapEx this year.
Exactly. They have to fund that gap somehow, either with debt or by using their reserves. Management knows this is an issue. They've said their goal is to improve asset productivity and optimize working capital. It's that classic high-growth problem. You burn cash today for profit tomorrow.
Which brings us perfectly to the efficiency check. The ultimate measure of whether all that capital is being used wisely is in the return ratios. Let's start with return on capital employed, or ROCE.
Right, and ROCE is so important here because it measures how well they're using all the capital, both equity and debt. Given the huge CapEx we just talked about, this ratio is critical. And the good news is it's improving. ROCE hit 14% as of March 2025. That's up from a low of just 3% a few years back. The trend is definitely in the right direction. It shows the new assets are starting to generate real returns.
Okay, and what about ROE, the return specifically on shareholders' money?
ROE, or return on equity, was at 11% in March 2025. But, and this is a key point, the 3-year average ROE is still quite low, around 7.86%. That's the hangover from that heavy investment phase.
So if that low average is the historical cost of building everything out, what kind of ROE do they need to hit in the next couple of years to really justify all this spending?
That's the million-dollar question, isn't it? And investors should demand that ROE moves well past 15% and quickly. Management's own internal target for asset turnover, between 1.2 and 1.4, suggests they know they have to sweat these new assets for all they're worth. The profitability is there. Now comes the test of efficient capital use.
All right, let's look to the future. Strategy, growth, and of course, risk. What's the vision management is selling, and what are the risks they're flagging themselves?
Well, the guidance is ambitious. They're aiming for a 15 to 20% revenue CAGR over the next 3 to 5 years, while keeping those EBITDA margins in the 28 to 30% range. And this isn't just talk. It's backed by an incredibly aggressive plan for capacity expansion. They plan to increase their manufacturing capacity by about 90% by FY27. They're adding 450 KL on top of their existing 600 KL base.
90%. They're essentially building a second company the size of their current one in just 3 years. That shows huge confidence in the order book. How are they making sure it's high margin capacity?
By focusing on the new complex stuff. The big investments are in things like peptides, oligonucleotides, and antibody-drug conjugates ADCs. These are highly specialized, high-science areas that get premium pricing and really deepen their moat. These new modalities already make up 7% of revenue, so the shift is happening.
Okay, let's talk about the risks that come with a plan that aggressive. What stands out?
2 big things. First is operational pressure. Management confirmed that utilization in Q1 was already between 77 and 80%, which they consider full capacity. Running that hot creates a real risk of bottlenecks. They could even have to turn down valuable orders until that huge new capacity comes online, which isn't until the second half of FY27. The execution risk for the next 18 months is very high.
And what's the second flag? Is there a regulatory issue?
Yes. The sources point to a specific pending GST appeal. The demand from the tax authorities is for about 36.68 crore, covering tax, interest, and penalties for a period from 2017 to 2022. While they're appealing it, it's still a measurable financial risk that investors need to track.
That's a great synthesis of the strategy and the reality on the ground. To wrap this up, let's distill it all down. What are the three biggest positives and the three biggest risks for an investor right now?
On the positive side, number one is the exceptional margin expansion and turnaround. I mean, getting the EBITDA margin to 29% and that 415% PATI's growth proves their strategy is working and the operating leverage is real. Second, the high-quality integrated customer base. Those deep, decade-long relationships with 18 of the top 25 pharma companies create stability and a very high barrier to entry. And third, their targeted strategic modality focus. The CapEx isn't random. It's aimed right at high-value areas like oligos and ADCs, which puts them ahead of the curve.
And on the flip side, the three biggest negatives or risk factors.
First has to be the working capital deterioration. That jump in working capital days to over 66 is a real strain on cash flow, especially when CapEx needs are so high. Second is the capacity pressure and execution risk. Running at 80% utilization is risky. They have to manage this gap perfectly until late FY27 without dropping any balls. Commissioning those new plants seamlessly is a massive operational challenge. And third, that regulatory and tax overhang. The pending 36.68 crore GST demand is a non-trivial risk that could hit the balance sheet if their appeal doesn't succeed.
So here's the final thought for you to take away. Sai Life Sciences is at a clear inflection point. Past investments are delivering big profits today, but they're effectively running two businesses at once, a highly profitable current operation and a second, equally large company being built on the side through massive CapEx and cash burn. Their long-term value really hinges on one question. Can management execute this huge 90% expansion into complex science, manage a very tight cash cycle, and navigate these regulatory hurdles all at the same time without compromising on quality or delivery? Success over the next 2 years will come down to flawless, high-stakes execution. Thank you for sharing your source material and joining this deep dive. We hope this analysis gives you the framework you need for your own continued scrutiny.